Welcome to the Optimize Monthly Snapshot. I'm David Ferreira, Portfolio Manager with Optimize Wealth Management. And for this snapshot, we'll update you on the moves in the markets over the past month, provide some highlights from our portfolios, and touch on some of the opportunities we see on the horizon. Global equity markets ended the month of August higher, with signs pointing to the US Federal Reserve beginning to lower interest rates at its September meeting, which ultimately materialized with a 50 basis point cut. Over the month, many countries and regions reported falling inflation rates, notably Canada, the US, and Europe. The TSX edged higher over the month, driven by gains in the infotech and real estate sectors. US equities also advanced, and yields on the 10-year Government of Canada bond were largely unchanged over the month, while those for the 10-year US Treasuries declined. The price of gold moved higher, while the price of oil finished lower, an exciting month as we approach Q4. Since we got that much anticipated rate cut in the US, let's talk about the recent US inflation data. Data for August showed a notable decline, with the headline rate dropping from 2.9% in July to 2.5%, the lowest level since February of 2021. Energy costs fell by 4%, driven by a significant 10% drop in gasoline prices and a 12% decline in fuel oil. Meanwhile, food prices saw a modest increase of around 2%, and shelter inflation edged up slightly to 5.5%. Core inflation, which excludes more volatile categories like food and energy, also held firm at 3.2%, its lowest level in 3 years. This gives further support that inflation is gradually moving towards the Federal Reserve's 2% target, and as a result, markets are pricing in more aggressive rate cuts into 2025 and 2026, which is positive for markets and the broader economy. Another notable trend we're seeing is the recent movement in sector leadership, with gains being led by defensive and interest rate sensitive sectors. Utilities has been the best performing sector of the S&P 500, up over 25% year to date as of September 17th, followed by financials and communication, up 22%, and industrials up about 18%. This sector rotation underscores the importance of active management, particularly as the economy transitions to a lower interest rate environment. This month, I also wanted to touch on pension-style assets, or PSAs, and the value they bring to client portfolios. When we talk about PSAs, we're referring to a range of asset classes typically found in large institutional portfolios, like those of pension funds or endowments. These include private debt, private equity, infrastructure, and large real estate holdings. While these assets have long been a staple for institutions, they've historically been out of reach for everyday investors due to high minimums and long lockup periods. The appeal for PSAs lies in a few key factors: their low correlation with the broader stock market, steady and reliable yields, and their ability to provide a meaningful diversification. Recently, retail investors have started paying more attention to PSAs, especially with new options like Apollo's private credit ETF on the horizon. But it's important to note that not all PSAs are created equal, and there's a very wide range of offerings in the private space. We believe the outlook for PSAs is positive, especially as interest rates begin to ease. For example, the yield on public investment grade debt are expected to drop as central banks cut rates, while private credit continues to offer very strong yields, making it an attractive option for income-focused investors. In addition, as interest rates fall, we expect a boost in infrastructure projects. These real assets have always been great as an inflation hedge, and their steady cash flows make them a valuable source of income for our portfolios. Overall, we see continued opportunities in the PSA space and expect these favorable trends to persist on a go-forward basis. Zooming in now to our position spotlight, this month we're taking a look at AT&T, one of the largest telecom companies in the US. The company's stock price has outperformed over the past year, up over 52% versus the S&P 500's 26% over the same period as of Tuesday's close. AT&T, with more than 100 million customers, has been able to deliver solid, consistent results and has a healthy dividend yield over 5%. We view the company's prospects positively for a number of reasons, including its continued investment in expanding its network, durable customer base, and overall financial strength. AT&T has also seen strong uptake for 5G and fiber, driven by consumer demand for faster speeds and more bandwidth, and we expect this trend to continue on a go-forward basis. The company's latest results have also shown subscriber growth surpass analyst expectations on greater demand for higher priced plans. In its most recent quarter, AT&T reported revenues just shy of $30 billion and increased its margins by 2.6% to a very healthy 38%. And given the contracted nature of its business, it's created more predictable revenue streams going forward. Overall, we reaffirm our outlook for AT&T as its attractive dividend yield and defensive nature has made the company a solid income-paying name in our portfolios. Finally, we take a look at investment opportunities ahead. On Wednesday, the US Federal Reserve cut its interest rate target by 50 basis points from its upper limit of 5.5% down to 5%. While markets had broadly expected the cut, it was larger than the 25 basis points that had been anticipated. Taking a look at where we've come from, the Fed's move represents the end of one of the most aggressive rate hiking cycles in history, as it sought to cool inflation that hit a high of 9.1% in the middle of 2022. With the most recent inflation figures coming in at 2.5%, the Fed highlighted the continued strength of the US economy and expressed greater confidence that inflation would continue to cool towards its 2% target. Central bank's focus has now pivoted to the employment market, where recent unemployment figures, while remaining low at 4.2%, have ticked up slightly. The Fed also indicated that they expect to lower rates by another 50 basis points by the end of the year, with further cuts into 2025. So what does this mean for investors? Lower interest rates are expected to provide tailwinds for the global economy as it lowers borrowing costs and spurs growth. Declining interest rates should also ease pressure on consumers and should help boost consumer spending. Interest rate cuts are also favorable for equity markets as they increase the attractiveness of stocks relative to bonds. Overall, we view the beginning of the Fed's interest rate cutting cycle as very supportive of the US economy and for the global economy as a whole. Economic fundamentals remain strong, and we believe that large, well-capitalized companies will continue to benefit from the more accommodative environment. And that's all for today's monthly market snapshot. It was an exciting month with some positive momentum heading into the back half of September. Thank you for tuning in, and we'll see you next time.